Perfect. Great. So, good morning, everyone. And thank you all for joining us today for, I think, what promises, for me at least, to be an insightful session on cyclical investing, value investing, growth investing. Maybe I think Nikhil will walk us through all that. But I'm super thrilled to have such a fantastic audience as well, who have shown a lot of interest in understanding more about innovative investment opportunities. And that is our endeavor to do and keep on doing such sessions every weekend, on Saturdays, Sundays, wherever we get an opportunity, to bring some of our best small case managers on this channel and introduce you to their philosophies, to their style of investing. And it's my pleasure to introduce our today's speaker, Nikhil Gangil, the founder of Intrinsic Value Equity Advisors. So just to introduce Nikhil, Nikhil is a seasoned investor. In fact, he prides himself to be called very specifically as a value investor, with over a decade of experience in the market, and his journey has been shaped by his deep commitment to the value investing. So on the qualifications front, Nikhil holds a MTech from IIT Madras and has worked with some of the most respected organizations in the industry like L&T and Worley. His industry experience spans sectors like construction, infrastructure, steel, oil, and marine business. And this hands-on experience, in fact, has helped him to deal with industries and companies which are truly cyclical in nature, and has given him invaluable insights into how to value these companies and how a value can be created for investors in such sectors. And of course, Nikhil lives by the motto that as a value investor, one should never underestimate growth. And as a growth investor, one should never underestimate value. I think with this balanced approach at heart of his is his investment strategy, which has been helping a lot of investors on small case. And today, of course, he will walk us through the art and science of his style of cyclical investing, sharing valuable insights that can help us all make smarter, more personalized, and of course, better investment choices. And like always, we will always have a Q&A session at the end of the conversation of Nikhil. So yeah, please join me in giving a warm welcome to Nikhil. Hey, Nikhil, good morning. And thanks a lot for joining in.
Good morning, Rakesh ji. It's been a long time. We are trying to do something together, and finally, we are on the same stage. It's an honor you gave me this opportunity to talk to people who are like-minded, who want to go for value investing, but they don't have the idea where to start or where to have this balanced approach. Thank you.
No, perfect. I think, Nikhil, you said it right. In fact, and especially in the current market scenario where lot of all this momentum and a lot of other things are happening, I think value takes a backseat, but it has always been the case, and it is nothing different this time as well. But as they say, value is the most, I think, investment philosophy which is based on first principles, and it has been time tested forever, for centuries, I believe, and it's always good to go back to basics. And of course, who better than you, Nikhil, to have some thoughts of yours on value investing, which you have been practicing now for over a decade with so much conviction. So yeah, Nikhil, I leave the stage open to you, and I'm sure you will walk us through a great journey of value investing today. And of course, we will have Q&A towards the end of your presentation.
Thank you, Rakesh ji. Thank you. Thanks a lot. And the people who have joined today and the people who will be watching after this session, hi, hello, how are you? And I'll be talking about very basic things today. The things that maybe very few people talk about, and the things that you need to hear today, right? So, and I'll start with very basic question: why most retail investors lose money? And I hope that would be the most basic thing to start our journey. And before I answer this question, for those who don't know me, I've been in the small case for last 2.5 years. Let me just give you an introduction. Hi, my name is Nikhil Gangil. I'm a SEBI registered research analyst. INH 00009047 is my SEBI registration number. I'm founder and CEO, Intrinsic Value Equity Advisors. In last 24 months, age of 31, we are managing 150 to 155 crore under our asset under our advisory. I'm ex-IIT Madras, ex-L&T, ex-Worley. I have lived in Oman, Saudi, UAE, and then I came back to India because I wanted to do investing and advisory full time. And more than 40,000 people follow us on Twitter, LinkedIn for our investing advices, investing strategies, and insights. And what I'll be telling you today, I think you will rarely see it in the Indian context because nobody talks about it. That is the secrets of cyclical investing. There are a lot of secrets as per say to do the do the successful investing. But out of that, one thing that is very, very important, I will be talking with you. But let's talk about first. Let's first talk about you. Let's talk about the pain point you are facing, right? Most of the retail investors, when they come to the market, they have these uh, issues, they have these problems which are inevitable, first of all, and very, very frequent, right? So I call them curious case of retail investors. So the first curious case of retail investor is that, okay, I came to market and I have spent nearly 3 months, 5 months, 7 months. Market is doing very well. There is a company that has given, let's say, 4x, 5x, 6x returns in last 5 to 7 years. Everything is going well. Financials are well in place. There is a huge momentum in the stock, and you buy a stock and the stock corrects. This has happened with a lot of people, right? And that is how they know that we don't have to buy on the top, that the hard way. This is how you learn it. The second curious case of retail investor is that there was a company which was doing hugely well, financial wise, stock wise, and you were smart enough. You did not buy it at the top, and you let it correct, and the stock corrects for nearly 15 to 20%. And after that, it corrects for 1 year, at least 6 months. And after that, you see some kind of momentum picking up, some kind of breakouts happening, some kind of MACD charts giving you those kind of indicators so that you can buy. And you buy the stock, and the stock corrects further, right? This is the most common thing that happens to the people who are in the market and follow the kind of investing which is called momentum investing nowadays. The third curious case of retail investor is, let's say you become the student of value investing after 2, 3 years, 4 years, because you understood that whenever you go for a breakout stock, whenever you go for a momentum stock, it corrects and it gives you capital loss, and you have already lost a lot of money. So what you do is you go for the companies which have been correcting for, let's say, last 4 to 5 years, 3 years, and they have corrected 40, 50%. You are quite confident that this company is undervalued right now. You go for the company, and company does nothing. So for next 2 years, 3 years, company does nothing. It goes into laggard zone. Basically, you can call it time correction. You can call it being a laggard. And then comes the fourth curious case. You've been invested in the company, does nothing. The financials are actually deteriorating, and the company continues to be undervalued. But since financials are deteriorating and the stock is not moving, you exit the company here, and the stock becomes multi-bagger within 6 to 7 months, 8 months. Now, what if I tell you 99% of the retail investors face this? When they buy, it corrects. When they buy a corrected stock, it corrects further. When they buy undervalued stock, it does not do anything. And when they exit undervalued stock, it becomes multi-bagger. Now, when this happens with retail investors, they think that there is something wrong with them. There's something wrong. And whatever they do, the opposite thing happens. They buy, it goes down. They exit, it goes up. They hold, it becomes laggard. Now, what if I tell you that there are not a lot of things that you are doing wrong? There's only one thing. And that one thing I'm going to talk to you today, right? Most retail investors lose money. Now, here's my answer: is not getting the cycle right. Most retail investors lose money because they don't get the cycle right. So newbie investors, they think that in the market, if you have understood the quality part, so if you go to the social media, if you go to influencers, and they talk to you about how to read P&L, how to read balance sheets, how to read, which is actually very good. If you go 20 years back in the market, there was no culture of learning about the finances, learning about the quality of businesses. But thinking that quality is the only thing that will make you money, I don't think it's a very naive thing to do. Most newbie investors think that buying a quality company is enough to do well in the market. It's not. It's actually bare minimum. If you don't understand the quality, you have no business in the market. But the real game is to get the cycle right. And this is the secret I wanted to talk to you about today. The real game is to get the cycle right. If you have pen and paper, you can write this down also. Now, to understand, now to get the cycle right, you have to first understand the cycle. Now, whatever I'm going to talk to you right now, this may be little jargon, this may be little on the financial side, technical side, but I'll try to make it very, very simple for you so that you understand it. I'll just take 5 to 7 minutes to take you through the cycles. There are 3 types of cycle which predominantly affect the stock price. First is economic cycle, second is business cycle, third is sentimental cycle. Now, economic cycle is nothing but the cycle your country is going through, right? You don't have to be an economist to understand that India is going through up cycle, right? China is going through an up cycle. Some of the European countries have their economy has been deteriorating for last 20, 30 years. Some European countries, the economy has been consolidating. US is facing a lot of issues lately. So that is nothing but the economic cycle. It's a decadal story. It goes for 2 decades, 3 decades, 4 decades before it changes its course. The second cycle is business cycle. Business also follow the same cycle as so do the countries. Businesses go through up cycles and down cycles. What can be the reason behind that? There can be export-import policies of the government. There can be regulation compliance. There can be competition. There can be significant capex. There can be margin contraction and also margin expansion. And this is why business also go through their cycles of ups and downs. Now, and third cycle is sentimental cycle. You have seen, even though the business have the same profit, same loss, same balance sheet, same debt, same reserves, the stocks go up by 10%, 20%, down by 20% every year or so, right? That is because of the sentimental cycle. That is because of some news has come, some event has happened, some corporate actions has done. Now, most of the people, most of the investors, they play in this zone. They are looking for some kind of news. They're looking for some kind of triggers, some kind of breakout, some kind of MACD, RSI, some super strength, so that they can make some 10, 20%. But the biggest amount of money is not made here. The biggest amount of money is made here. So what is business cycle? I'll just explain to you in 4 to 5 minutes. Let's say you have a factory to make this bottle. Now you make this bottle for 50 rupees and you sell it for 250 rupees. Now your profits are nearly 200 rupees if you remove expenses that is related to the personal expenses. So the profit is 200 rupees. Your stock is listed in the market. You are having huge, great profit margins, and your investors are seeing it. Your mostly the people who invest in the market are seeing it. And since you have great profit margins, the stock has gone up to 6x, 7x, 8x. The media is covering your story because you have been very, very successful. But what happens after that? Since the investors are seeing it, your competitors are also seeing it, your relatives are also seeing it, your friends and families are also seeing it. Now they decided also to make a factory of their own where they can make the same product for 50 rupees. And since they have to cover the market, they started selling it for 150 rupees, right? So what happens? Your market share drops, or the second thing what can happen is you run a service business. The government thinks that there's been some irregularity happening, so government comes with some regulation that affects your operating profit margins. Now, in the both condition, investors are again seeing it. When the investors are seeing it, your stock slumps by 30%, 40%, 50%. So this is what cyclical effect means. So this is what cyclical effect means. So that is what brings the stocks down and up. Now, what happens after, let's say, 1 year or 2 year? So there have been a lot of competitors in the market. You try to squeeze them out, right? So what you do, you further lower the prices either, or you enhance the quality, or you cut your profit margins, or you try to squeeze them out of the market by going very, very competitive in the market. That is what you do, right? After you squeeze them out, after 1 year, 2 years, it will take 1 year to 2 years at least. After you squeeze them out, you again do very well as a business. And that is where your upcycle starts again, right? And the stock does again 4x, 5x from there. In the case of regulation, government can understand that they have been very hard on the service industry and they can remove some of those regulations. And that is where the upcycle starts. The big money is made here. That is what I'm trying to say. So the stock price is nothing but the superimposition of these three cycles: economic cycle, business cycle, sentimental cycle. When you overlap these three cycles, this is where you get the stock price. As an intrinsic value firm, what we try to do is we try to calculate the maximum intrinsic value and the minimum intrinsic value. What are these values? These values are nothing but the minimum possible and maximum possible value of a company, of a stock, given the fundamentals and given their cash flow, given their profits, given their debt, given their equity. And we try to calculate some of the zones with good amount of accuracy, the prices where the stocks can be, the minimum and the maximum. And we try to buy those companies near to this zone with good amount of accuracy, and we try to exit the companies here. And that is what value investing is. Because if you buy here, either you win or you don't lose. There's only two conditions, right? But if you buy here, either you don't lose or you lose a lot, right? Now, what happens when you buy hot stocks? Let's say there are companies which are in the media right now, which has done very, very well. The curious case number 1, right? Curious case number 1 and 2. The company has done very, very well. The stock has also done very well. The company is already going through its upcycle. You can see here. And the sentimental cycle is also at the peak or at the bottom. Let's say the stock has gone down by 15 or 20% in the second curious case of retail investor, right? In both cases, curious case number 1 and curious case number 2, you are investing here. And when you invest here, this is your future, right? So when you invest at overvalue, when you invest at the top of the cycle, this is what happens. If you are buying a large company, you may underperform. You may not get your returns back for next 5 years, 7 years. You will be making 0% returns 5 years, 7 years. If you are investing in a small company, the stock goes down by 50%, 60%. Now, what happened into Asian Paints? Now, Asian Paints is a huge quality company, right? Great quality, great market share. What happened? The same thing, the same example that I shared. Supply demand got disrupted because of new players. This is one of my tweet when I said in one of my stock, KRBL is down 10%, while Asian Paint is only down by 1.3%. This is nearly 14th Feb 2022. I would still buy more of KRBL today rather than Asian Paint at the current valuation. Now that is delayed gratification for me. Now the funny part is, it's been 2.5 years. KRBL has also not worked. So KRBL also up by 20, 30, 40% only. But still it's beating Asian Paint by 25% CAGR. So 25% yearly outperformance it is giving on Asian Paint. Both are quality company, both have good market share. One might say that Asian Paint has bigger valuation, bigger market share than the KRBL. Looking at the next example, Hindustan Unilever. As I told you, we calculate minimum and maximum intrinsic value. That the maximum intrinsic value of Hindustan Unilever I shared in 2020. That was nearly 3,059. It's been 4 years. It's been 4 years, guys. Hindustan Unilever has not made, the stock has not gone up by 2,873. Now, that is the power of valuation. That is the power of, in March 2020, I remember, you could have bought anything. You could have bought anything. It could have made you 3x, 5x, 7x returns. But I know a lot of people personally, they bought Hindustan Unilever. And the thought process was that the whole market is going down. The whole market is correcting by 15%, 20%. And Hindustan Unilever is not bulging. Hindustan Unilever is up by 5 or 7%. Hindustan Unilever was up by nearly 15% in that correction phase, in the March 2020 phase. And some people just bought it due to that momentum, due to that relative strength concept. And they are still holding the company with some 5-10% profits. If you could have bought anything that time, you would have made 4x, 5x, 7x returns. So again, Hindustan Unilever, great quality company. But this is what happens when you buy the companies at the top of their cycle. The business have already performed. The stock price has already outdone the business performance. Third example, the same thing happened in specialty chemicals and IT companies, right? And this is the article that I shared in 2022. I called them traps, specialty chemicals and IT companies. And I said, let's take an example of IT and specialty chemical companies. Business have performed well in the past, but stock performance has outdone the performance. Even next 2 years forward fundamentals are priced in their stock price. And now since they have corrected, this is where they are. So they were literally in the curious case of retail investor number 2. And when you buy here, this is what you get. And this is exactly what specialty chemical and IT stockholders have got in nearly last 2.5 years. They have not made anything. If you had invested in small companies, you have corrected by 40 or 50% also. If you were invested in big companies like TCS, Infosys, you have not made anything in last 2.5 years. While literally the whole market has done very, very good. So this is what happens when you buy overvalued companies at the top of the cycle. Now, what happens when you buy at the bottom of the cycle? Let's say the business was not doing well. The whole industry was not doing well. Let me share an example with you. How to understand that a business or the industry is not doing well. In 2019, the whole auto sector, it was not doing well. Okay, because there was an issue of BS4 and BS6. The companies were correcting, and I saw that one segment is there, auto ancillary. They were correcting a lot. Now, the auto companies were correcting by 20-30%, but auto ancillary, they were correcting by 40-50% also. So this is how you know that this cycle is in the down cycle. And let's say there's a sentimental cycle is also top at the bottom or the bottom. In the both cases, you buy here. And when you buy here, this is your future. And this is where you make multi-baggers. This is how you, with a great amount of accuracy, you get multi-baggers. Now, what happened in real estate companies? Corona led to growth eventually. In 2021, when everybody was buying, I gave you auto example. Let me just finish that one. So in the auto companies, what happened was that the companies were not doing very well. The stock price had corrected. And I figured out that there were 2 auto ancillary companies which had nothing to do with the BS4, BS6 issue. I'm talking about 2019. The issue of EV, ethanol, it has come nearly 2023, 2022. Okay. So we did not even know those issues in 2019 when we invested. But I understood that even though there is a BS4 or government regulated BS6, the axle shaft companies, the companies which make axle shaft and the companies which make automotive lighting, they are not going to get affected, right? And on that basis, I bought one axle shaft company and one automotive light companies. Both of those companies have become 7x, 7x and 8x company in last 3 to 4 years. The same happened in real estate when everybody was buying in 2021 IT and specialty chemicals, as I told you in the uh, in the the article that I shared. We were buying some of the real estate companies, and that real estate company has become 12x till now, while the IT and specialty chemicals are struggling to come to 0. The same thing happened in infra companies. In 2020-21, if I had told you that go into the infra companies, buy some PSU companies or buy some pharma companies, if I had told you in 2023, people would have laughed. In 2020, there was a term which used to call PSU companies at the cash cow companies, right? And there was a term when people used to call infra companies are loser company or power company as loser company. And we bought that time. And right now the everybody knows the result of that, right? So this is what happens when you buy companies at top of their cycle, and this is what happens when you buy companies at the bottom of their cycle. Now, a great question here is that how to understand whether the company is going through its top cycle or the bottom cycle, right? It's actually very easy to understand. You have to look for the companies, you have to look for the sectors which have been out of favor for last 2 to 3 years. Let's say if I had told you that lubricant companies are going out of favor 1 year back, you would have laughed at me, right? Because there was a huge hype of EV companies. Everybody was just looking for the companies which are somehow related to EV, uh, maybe they are just making some panels, maybe they are just making some uh, cells, or they're just into in fact manufacturing or just installation. And in the auto sector was also not affected, not unaffected, right? And I talked about lubricant companies that time in 2023, and people just said, okay, you don't know anything about investing, Nikhil. Because everybody is talking about EV and ethanol, you are talking about lubricant. And maybe you don't know, but in EV the lubricant uses are very, very less, which is going to make the lubricant companies redundant in next 5 to 7 years. Right now we are in 2024. Some of the lubricant companies I talked about are already become 3x, 4x, right? Some of the large names, some of the obvious names, by the way, the market share wise. Okay. So this is what happens when you buy the companies at their low cycle. You don't have to be a huge mind reader to understand that these companies are going to do well or not, right? And today, why I've come in front of you is because one such cyclical shift is happening right now. What happened in 2021? What happened in 2020? What happened in 2019? A lot of small cap companies, I'm not saying all of the small cap companies, but a lot of small cap companies where there's a huge momentum commentary is going on. Those companies have already gone into very, very high risk and very, very low reward zone. I'm not saying that those companies cannot give 10-20% from here, but the risk is huge. That if the risk is 50% and the returns are 10%, then definitely it's not worth it. The risk to reward ratio should definitely be, if there's a reward of 100%, the risk should be 10 to 20%. That is what I feel as a value investor. Maybe I'm just biased. One such cyclical shift is happening right now as we speak. Some of the companies from small cap has become very, very overvalued. And some of the companies from large cap have become very, very, very undervalued. And that is why we have come up with hand holding with one of our small cases right now, that the name is Large. The Large is a pool of 5 large companies which has the potential to beat even Nifty small cap for at least 1 year or 2 years. I'm not saying that don't go into small cap companies, don't go into SME. See, SME sector is definitely overhyped. I would definitely suggest you to, if you have made money, just try to make profits. If you don't have made money, try to come out of it. I'm not saying that you don't go into small cap companies, but I'm just trying to say that have a balanced view. If you don't have the exposure to large cap right now, or that too specific, those large caps which are undervalued, it is a great time to think about it. We have just launched this large cap, small case, and I think this is going to give you a huge exposure into large caps, and it's going to make your journey very, very feasible in the next coming years. Now, there are 6 reasons why you should opt. The average market cap of the companies are more than 50K crore. So it's the least amount of volatility you will face. And some of the companies are correcting. So the index in the small case can show high volatility, but trust me on this, from value investing perspective, they are very least volatile. The holding period is 2 years to 5 years. So if you're a believer of long-term investing, you can definitely look for this one. The timely updates, not only you will get on the mails, but also on the social media, where I keep talking about if the rebalances happened, if some adding in the portfolio has happened. Now, one thing I very much like about small case is they give you the automation that actually helps you. You are a professional. You don't want to, lose your professional commitments. All you want is one-click solution which can help you invest your money wisely. Now that you get with the small case. All of the rebalancing and exit updates you are going to receive over the mails and through our app, also through our social medias also, and you'll get all those rebalancing exit updates. And finally, we are SEBI registered and NISM certified people. Now, I'll just dictate once more who should invest and who should stay away. Busy professionals, as I said, if you are, let's say, you have professional commitments, you have 9 to 5 jobs, you have meetings to take care, clients to take care, and you don't want to go into those investment solution where you have to look at your portfolio every 7 days, every 10 days, every 15 days. I think this is the best thing that can happen to you, because the holding period is 2 to 5 years and we rarely rebalance. Our rebalance can be shifted from 3 months to 5 months, 6 months also, because nothing changes in value investing. That's the best part of value investing. If you have already holdings in small caps, let's say you already have holdings in some momentum portfolios, which is very good for last 2 years, then you should definitely go for this one, because this will give you a balanced view. So let's say you already have some small cap companies, you already have some growth companies, momentum companies, our own small cap companies, like some Cash King. We have a Cash King portfolio also, which has one of the best returns in the country. You should have a balanced view. You should have balanced view, and this is the best time to have that balanced view, because I told you such cyclical shift is happening right now as we speak. What you get, you want automation with small case, you want no noise investing, no daily level commentary, weekly level commentary, monthly level commentary. You just want some peaceful investing solutions. Now, these are the people who should invest. Who should stay away? If you want daily calls, if you want daily, the momentum excites you, ऊपर गया, नीचे गया, बड़ा मजा आता है. If you enjoy that, you should stay away. No FNO, no momentum, no daily calls, no daily, weekly, monthly commentary. Guys, this is a peaceful investing solutions for the professionals, for the businessmen, for the people who want to have less and less, let's say, who wants to have less and less worry about their portfolio, and they just want to have quarterly or bi-quarterly rebalance. We have launched it today. Rakesh ji connected with me and he said that let's launch for the small case people first and give them some kind of discount. and this is why we are here. So the nominal cost of the small case is 15,340, but with the latest price and the latest code we are launching today, it will cost you 5499. So this is what you pay. So definitely, before doing payment, let me just give you my introduction again. I'm founder, CEO, Intrinsic Value Equity Advisor. We have nearly 155 crore asset under our advisory. I'm ex-IIT Madras, ex-L&T, ex-Worley, and more than 40,000 people follow us for our investing related insights. We have great number of client testimonials in last 2.5 years from small case people all across the country. Paul Inasu is a technical superintendent. Narendra is a government employee. Sudhanshu is a vice president. Vasuraj is a doctor. Vikram, director. Huge number of client testimonials we have received for last 2.5 years by investing in small case, and lot of people, it really gives me joy and pride both that a lot of people got their first multi-bagger with us. Okay, this is what we are very good at. So see, Amit Agrawal, he is a founder and CEO of nobroker.com. This is what he has to say. Nikhil, your portfolio is doing fabulously well. Thanks for the above message. My first multi-bagger, my first ever 100% returns in the stocks. Out of 31 stocks, 30 are in the green zone, only one stock in red. Despite carnage, the stocks I bought from your recommendation are up by 2%. निखिल जी, एक ही दिल है, कितनी बार जीतोगे, रोज ना रोज आपका कोई ना कोई रिकमेंड किया स्टॉक हीरो रहता है कभी. Then he's talking about some stocks that we bought. So we have huge number of client success stories, and this is what I wanted to basically say. There's a QR code, and you can go through that. And if you want link, the link will also be provided to you. You can use the coupon code that has been specially curated for you. And please do not let this opportunity go. Thank you.
Thank you, Nikhil. Thanks a lot for that insightful presentation and your journey. I'm sure a lot of people must have got a lot of cues and direction to start their investing journey, if at all they have not started one. And of course, there is always a scope to invest via strategies which complement your existing strategies as well. And that's the best way to approach the current markets. Nikhil, as discussed, we do have a couple of questions from users, from viewers who have been watching the webinar. And of course, we had floated some form as well earlier before this webinar, where we have got some question. So first, I think there is a question saying that if you can help us understand more about your Cash King portfolio. I think you have one of the small case, which is Cash King name. So if you can just throw some light on the philosophy. For that matter, Nikhil, why don't you just walk us through your 2-3 small cases, whatever you have, and the underlying thought, what you do on those schemes, and who are they, like suitable for what kind of investors, so that people can take some informed decisions before investing in your specific small cases.
Great. Allow me to share at least 2-liners for each and every small case that we run. Now, I want people to understand the core philosophy. That core philosophy is value investing itself. We calculate the minimum possible and maximum possible value of the companies, and when we find that the price is very near to the minimum intrinsic value, we try to buy those companies so that we have a huge profit margin potential and very low loss potential. So the core philosophy is that only. Now, in core stocks, the number of stocks are 20 to 22. The Cash King, the number of stocks are 10 to 15. And the Cash King, the ranking, the number of stocks are 10 to 15. And the Cash King, the number of stocks are 5 to 7. Cash King are the companies which have a great cash holdings in their, let's say they have a, the companies which have a high cash holdings, and yet the margin of safety is huge, and they have a growth potential for next 3 to 5 years. Ranking is basically the companies which we have a ranking system basically, Rakesh ji. तो उसमें हम कंपनीज को रैंक करते हैं. देयर आर 900 कंपनीज एंड हम उनको रैंक करते हैं बेस्ड ऑन सेल्स ग्रोथ, बेस्ड ऑन आरओसी एंड बेस्ड ऑन जो हमारा प्राइस टू बुक। एंड जब उसमें से हमारे पास बेस्ट कंपनीज निकलती हैं, हम उनको मार्जिन ऑफ सेफ्टी के पैरामीटर पे चेक करते हैं, एंड सम ऑफ दोज कंपनीज वी ट्राई टू कीप इट इन द रैंकिंग पोर्टफोलियो। एंड core is our flagship product, where we have lot of companies, lot of stock names from different strategy. We calculate their minimum and maximum intrinsic value, and we try to buy those companies. That one more difference is that the risk part, because core has 22 number of stocks. There are people who want to go only with us, so they want a diversified investment solution with us. So that is why they go for core. There are people who want moderate risk, moderate returns. So in terms of core, I would say it's least amount of risky, because A, we are following the margin of safety. B, we are diversified. C, we are not taking any leverage. So these are the only three risks and we have mitigated all of them through core. In Cash King, we have a concentrated portfolio. जैसे कि मान लो आपका कोई और small case चल रहा है, या कोई और mutual fund चल रहा है, and now you want to have some 4 or 5 companies only, and you are able to take the good amount of risk, the risk that comes from the concentration of the portfolio. So you can go for the Cash King. And because of that only, the Cash King, if you see the performance wise, it has outdone almost every small case. And तीसरा हमारा है ranking portfolio, which is based on the ranking. And it is, I would say, moderate risk, moderate returns kind of portfolio.
Got it. Okay. So you can, I think I've stopped the screen sharing, right?
Yes, the presentation is not there.
Okay, perfect. Okay, so 1 second. Yeah. So I have one more question from Chaitanya, who is asking that what kind of amount should one invest in your large cap, small case, which you have just launched, like minimum or maximum investment amount? Of course, you can always help him with some allocation percentage in his overall investment strategy or overall portfolio.
So we don't have any minimum amount requirement as per, but let's say you are paying 6,000 as a fee, 5,500 as a fee. It should be not more than 2.5% of your overall portfolio. So you should at least invest 2 to 2.5 lakhs. That too over the year. Let's say you want to do SIP of 20,000, 30,000 over every month. So you can do that. And as far as the maximum amount is concerned, you can invest anything that you can invest 1-2 crore also. Apart from that, if you talk about allocation, I would definitely suggest people to have 30% allocation in the large cap also, because if you have 70% allocation in a small cap already, 30% you should definitely have in the large cap. And very few people are coming up with large right now. Most of the people are talking about SMEs and IPOs, and that is quite understandable, because it's bull market. Everybody wants to ride the highway, but this highway will end someday, right? So you have to be prepared for that also.
Got it. So there is this common perception that value investing is more about buy and hold and not doing anything, or some call it a lazy investing. So a lot of our investors, they are always worried that whenever there is no changes happening in the portfolio, like in our small case parlance, we call them rebalance. So especially when the rebalances are very few or rare, sometimes the investors feel that कोई देख नहीं रहा हमारे पोर्टफोलियो को, क्या हो रहा है पोर्टफोलियो में. So if you can give some context that no rebalance is also one type of action, and of course there is somebody who is reviewing the portfolio regularly. It's just that there are no changes doesn't mean that there are no actions. So if you can throw some light on your thought process on when you rebalance the portfolio and how frequent they are, if at all they are.
It is a common perception. ऐसा होता है कि अगर एक क्वार्टर तक कोई रीबैलेंस नहीं आया, डेढ़ क्वार्टर तक कोई रीबैलेंस नहीं आया, तो people think अरे fund manager is not working. I have just paid money for some old list of the stocks, and now he's not even looking at that. It's not right. The thing is that we don't have to look at it till one quarter ends, because हम businesses को ट्रैक कर रहे हैं. हम जब businesses को ट्रैक करते हैं तो हम quarterly actions लेते हैं, ना कि weekly or monthly, because we don't take actions based on the price. We don't take actions based on the momentum. We take actions based on the financials, and financials only change quarterly. And trust me, when we invest, we work harder than, क्योंकि प्राइस तो चार्ट पे दिख जाता है, बट फाइनेंशियल्स हमेशा एनुअल रिपोर्ट्स में नहीं दिखते हैं, तो आपको यू हैव टू वर्क हार्डर. सो इट्स अ कॉमन परसेप्शन कि आई हैव ऑलरेडी पेड द प्राइस बट द मैनेजर इज नॉट वर्किंग एट ऑल. I don't think we should go into that. And as you correctly said, that no action is also an action. You have to stay invested because the bigger money, आप मार्केट में किसी को भी देखो, बड़ा पैसा जिसने बनाया है लॉन्ग टर्म में ही बनाया है. शॉर्ट टर्म वाले में आपको कोई इतना नहीं मिलेगा कि दे हैव मेड ह्यूज अमाउंट ऑफ मनी. So the bigger money is always in the taxation is with you, the regulations are with you, the market, the government is with you because they have already given you the huge LTCG discounts. तो जहाँ सारे ये benefits हैं वहीं आपको जाना चाहिए मेरे हिसाब से. And if we do rebalance after every week, every month, you may think some kind of action is happening, but when you look at it from 2 years, 3 years point of view, you realize कि actually कुछ बना नहीं है ज्यादा, and the against the efforts that you make, right?
Got it. Got it. So just picking up from this, Nikhil, coming back to value investing, as they say, growth investing is for bulls and value investing is for bears. And you, as a value investor, always wait for bear markets to get active. So how you, as a value investor, participate in the current raging bull markets, right? Do you still see a lot of pockets of values still emerging in the current euphoric times as well, if I may call it? Of course, a lot of people say this is just the beginning. And of course, the markets will always have both sided opinions. And that is why we always have a buy and a sell. But in this context, what are your thoughts on the current market scenario and how you see value in this markets?
We try to do, Rakesh ji, we try to do advanced value investing. As आपने भी मेरा introduction दिया तो आपने बोला कि this is the term that I have strongly believed in. A value investor should never underestimate growth. A growth investor should never underestimate value. So what we try to do is try to have a fusion out of it. Okay. So if there is a growth, then definitely there are value backwards. And if there is no growth and the stock is overvalued, you should definitely get out of it. So the opposite is also true. The valuation is very, very good, but there is no growth. Then that can be a value trap. But valuation is there. Value is on your side. Maybe not exactly the bottom, but there is growth, then you should definitely go in. So when you try to use this fusion, when you try to have an open mind as a value investor, you see a lot of opportunities. And I'm also a strong believer of there are always opportunities, there are always traps. जैसे कि मैंने हिंदुस्तान यूनिलीवर का एग्जांपल शेयर किया. You could have bought anything in 2020, you would have made money. But I know people who bought Hindustan Unilever and they have not made any money in last 4 years, 5 years. There are always opportunities, there are always traps.
Got it. Now, coming to your portfolio construction, Nikhil, like, do you have some allocations in mind to a particular sector or to a particular stock, which takes care of the risk management as well, no matter how strong you are convinced about a story or a stock or a sector? How do you manage the risk part of it? Because in the current markets, of course, the whole conversation is always about returns and all the spotlight is on returns without even getting into that conversation. Okay, what is the kind of risk one is taking to expect that those kind of returns, if at all they get those returns? So how you play the risk part of it, and as they say, if you are successful in managing your risk, returns is more of an outcome, which could be much more than what you have thought in your thesis.
Right. As you rightly said, we also believe that if you could manage your losses, if you could, neglect your losses, the high CAGR is only the only outcome, right? So according to me, there are only 3 risks in the market. One is leverage, and that is why we suggest long-term investing. We don't go into FNO and all those leverage games where you take leverage from the broker. Second risk is concentration. This is why I always suggest you to have 15 to 20 stocks at least in the market, because basically diversification is key against the ignorance. The things that you must have left, the things that you had to study but you couldn't study, And then there is third risk of overvaluation. And that is why we play the game of value investing. So by mitigating all these three risks, we are already in a very, very sweet spot. And whenever there is a bull market hits, or even though we have seen very good performance in the sideways market also. I cannot hear you. You have to unmute.
Sorry, my bad. So I was just going through if I have more questions which I can just pick up. So again, this is a very standard question which I get on every webinar, and rightly so, for the current mood of the market, that people are always worried that is it the right time to invest in markets in general and intrinsic value small case in particular.
Yeah, so the answer is very similar to what I already said. I will reiterate. There are always opportunities and there are always traps. I shared one example with you of Hindustan Unilever. That was a example of trap. You could have bought anything, but you bought Hindustan Unilever and now you are trapped in that for 4 years. Very good quality company. Everything is very good, but you miss the whole bull rally. I will share one example with you that is of opportunity. In 2021, when everybody was crazy about IT companies, specialty chemicals companies, we saw that there is some opportunity in real estate segment and hospitality segment. And we bought two companies from one from real estate and one from hospitality. The real estate one is nearly 12x today, while IT is not doing anything. And hospitality also did 50-70% up, which we had to exit because it was not becoming multi-bagger. But if you look at the average, the opportunity size was huge. And if you remember, November 2021 was also similar to today only. It was overvalued. Everyone was the experienced investor were very bearish about the market, but we got those opportunities that time also.
Got it. Okay, so now I have one more question. Okay, he has kept his name anonymous. Okay, talking about cycles, right? There is this one sector which is just not willing to come out of a bear cycle, and which is chemical sector. So the gentleman is asking how much time will it take more for the sector to shine, and your comments on Aarti Industries.
First, I'll give you some general answer about this. Every sector has their own timeline. Let's say real estate has its own cycle. Chemical has its own cycle. Sugar has its own cycle. Some might underperform for 3 years. Some might underperform for 5 or 7 years also. Now, chemical also has two segments. Now, let's say one is agrochemical, one is specialty chemical, third is general chemical. We are bullish on agrochemical for last, let's say, 1 year. We talked about rallies, we talked about UPL, and chemical sector, we have just starting to put it in watch list. And I think something might come, and some bottom making might happen in next 3 to 5 months, 7 months, depending on the market also.
Okay. Any thing specific, or it's just about that time element which you are talking about, that usually every cycle starts and ends in a particular time frame, and based on your experience you are saying
Right.
this?
As we see that cyclical charts, it goes up and it goes down, and then there is a time which it does nothing. So you can call it time correction, or you can call it basically anything that is trough. So it goes down. It has already gone down. Now it is in that zone where it is looking for some triggers so that it can go up. And whenever those triggers happen, that is what we track also, cyclical triggers, we call them. So some of those cyclical triggers we track, and then we try to make some allocation in those companies.
Got it. You just spoke about agrochemicals, Nikhil. So one question is coming on agrochemicals. So there is a lot of this overcapacity in agrochemical in China. Do you think this overcapacity in China will lead to dumping in India, affecting the business?
See, I think government will take necessary actions, because whenever these things happen, we try to overanalyze these issues, but we forget that we are not the doer in this scenario. The doer is above us, and they are already monitoring these things. And it is their responsibility also that Indian industries make money. So we have seen governments doing anti-dumping duty, and trying to restrict the overseas companies when and time whenever is required. So I trust the regulators on this.
Right. So which according to you now are the sectors like which have been like were right under there and now they are like trying to look up in the future from the sector's point of view, from the cycle's point of view,
So
overall
three
business
sectors
cycle.
I was tracking. Yes.
Yeah. No, no, please.
Okay. Three sectors I was looking at in 2023. They have just come out of the down cycle, but they have not yet fully grown. One is FMEG, that is fast moving electrical goods. Second was agrochemical. Sorry, no, second was biotech, and third was some retail companies. Now, retail sector as overall it is overvalued, but some opportunities were there which were undervalued. In 2024, we have more focused on agrochemical companies, specialty chemical companies, and pharma was also somewhat undervalued in the generic pharma, which we picked up in 2023 also. So these 5 to 6 sectors, I would say, either they are at their bottom, or they are going to make bottom, or they have just come out of bottom. So this is the sweet spot basically.
So when you, Nikhil, this is something from my side and out of curiosity, I'm asking, like when you index so much heavily on value as a philosophy, do you think you might miss out on the future growth prospects of, especially say the new age companies like say Zomato and all this policy bazaars of the world and all this, of course, the new age companies where the scale can be humongous, right? After that tipping point. So as a value investor, because these are the companies who don't usually fit into the value investing framework, because even if you want to put some numbers, you will not get those numbers, right? So how you, if at all you want to take call on certain companies like this, how you take those calls, or you just stay away from these companies?
So yes, this was a main issue when we were doing value investing nearly 5 to 6 years back, and that is why I told you a value investor should never underestimate the growth. So that's just not a motto for us. That is the whole methodology. The when we try to calculate minimum and maximum intrinsic values, we index them as per the industry. So IT will, for IT, minimum and maximum intrinsic value will work differently. For real estate, it will work differently. For chemical sector, it will work differently. So let's say in chemical, the minimum intrinsic value comes at the price to book ratio of 2. But in IT company, it can come at the price to book of 6 or 7 also. So talking about today, that so if the Zomato picks up from here, I would totally miss it. If Naukri, TCS, Infosys, Wipro, if they pick up from here, I would totally miss it. But I have trust that they will come at our value also, and we will try to pick them.
Perfect. I think, Nikhil, this was a great conversation, and I'm sure even our viewers would have picked up a lot of things for their investments. And I'm sure they would be evaluating your small cases and look forward to participate in this investment journey. So before we wrap up, Nikhil, would be great if you can have some closing remarks, and then we can call it for a day.
Okay. Thank you, Rakesh ji. I would just say that this cyclical and the value investing is just not the gyan. It is perfectly practical tools so that you can, what Mohnish Pabrai says, that if you are investing, you try to lose less and you try to make more. And losing less is more important than making more. So because when you lose less, the good CAGRs are the natural and only outcomes. So try to make less loses, try to invest in the companies where the margin of safety is huge, because when the cycle turn for them, you will anyway make very, very good returns. Thank you.
This is super helpful, Nikhil, and thanks once again for sharing your philosophy, insights on your journey and intrinsic value. And I'm looking forward to have more such sessions in future and pick your brains on the way markets are evolving. And
Thank you,
yeah,
Rakesh.
wishing you all the best and wishing all our viewers happy investing. Have a great weekend.
Thank you, Rakesh ji. It was honored to come to your platform and talk about investing, and very wonderful people today asked
Yeah,
a lot of questions. Thank you very much.
pleasure. Thank you. Take care.
Thank you.
Bye.
Take care.